I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We cling to totems in this business, and often those totems actually lead us in the right direction. Last week, I told you the market was oversold, the deepest oversold level since the pandemic began. And I thought that seemed extreme versus the backdrop. Remember, I said sentiment got much too negative. So unless we got a sudden spike in COVID fatalities, not cases, fatalities, so far so good, we're due for a bounce, which meant it was time to hold your nose and buy something. Sure enough, the Dow roared 647 points, S&P jumped 1.17%, and the Nasdaq rallied 0.93%. It was a textbook oversold bounce. So therefore, the question is, are we looking at a sustainable rally or merely a temporary short squeeze? Many hedge funds were caught with their proverbial pants down. There's only so far that we can go on sentiment alone, and that's what drove this. Sentiment, okay? We need to see something tangible, something real. So let's see. How did the day unfold? Sometimes that gives us the clue. Now, the morning's trading begins about an hour before dawn, when if you watch the bottom of your screen, you can see many prominent Nasdaq names getting crushed while the S&P 500 names held up well. What's weird about this, though, is it's a pattern that starts in the early morning hours. For instance, if you were up at 5 a.m. to watch CNBC, you'll typically get a sense of what the day might look like. And this morning, the sellers were getting insanely bad prices. It was almost like no matter what tech names they dumped, they were willing to obliterate the stock. It was almost as if they wanted to drive the Nasdaq down as much as possible. And you know what? I'm not paranoid. That is a real possibility. These early morning moves are done on almost no volume, though. They feel as if someone is, I'm going to give a technical term here, painting the tape. And that's a way to influence stocks so that they, in this case, look heavier than they really are. Heavier meaning more likely to collapse. Now, I'm not going to accuse anyone of market manipulation. I can't prove it. But this kind of action certainly raises eyebrows. The moves, heavily concentrated from 5 to 6 a.m., were commented on endlessly by market observers, and therefore they set a negative tone narrative. Could they be doing it to take the whole market down? Is that what these traders are doing? Or then again, maybe the sellers are just so stupid they didn't know what was going to go on. Even as the Nasdaq ultimately did lag behind the S&P, saved by the mega caps. Still, I wouldn't place too much faith in their stupidity. Apple was the most important stock in the Nasdaq. That came out strong right out of the gate. Other than Apple, though, the early morning sell-off in tech seemed totally out of touch with reality. And I do believe there were people trying to create a climate and reality of fear. And they almost succeeded in doing that and getting you to sell your stocks. I didn't want that to happen, hence the 9 o'clock show. But now, generally speaking, this market reacts not to the ephemeral, but to three things. It reacts to earnings, the Fed, and COVID. Obviously, we had no earnings this weekend, right? It's not like Bitcoin goes, oh, it's down 20%. Thank heavens, at least stocks don't trade like that. The Fed already spoke last week. They're done speaking. And that leaves COVID. But the COVID news this weekend was actually positive. If you watch the talk shows this weekend, you would know that there's so far, and I have to keep saying it, but so far, nothing special about this Omicron strain, except that it could become the dominant one. And more important, it seems to make you less sick than the Delta variant. Dr. Gottlieb couldn't confirm that, and Dr. Topol can't either, but those are my two totems in that business. If fear, though, breeds selling, then less fear should breed less selling or actual buying. And that's what we ultimately got this time by when the market opened. So I'm begging you, please don't take your cue from the phony pre-market action. Wait for the real action after the morning's research comes out and traders actually show up to work. The higher the volume, the less likely it is that the stocks are being manipulated. With that in mind, how do we get a read on today's action? Okay, markets have multiple leaders. Sometimes it's really the FANG stocks that lead the way, and there was some good action in there. More on that later. But the best leaders are the transports. The transports. Why? Because they show you that commerce is accelerating right here. And then the second best are the banks, because they show you that lending is expanding when they go higher. When these two groups are in good shape and go up in tandem, it is very, very rare. But the pin action is Tremendous! Today, right from the get-go, the airline and the travel stocks took off. That's an amazing sign. It means the vacationers of the world are less worried about the Omicron strain than their governments are. Historically, these stocks have traded down on travel restrictions. This time, the buyers of Marriott, Delta, United, Southwest, and so many others told you that either the authorities are boys who cried wolf, or perhaps COVID has become an acceptable risk. Foolishly acceptable for those who are unvaccinated, but reasonably and, yes, rationally acceptable if you've got your shots, particularly 3 of them. Remember, the thing Wall Street fears most isn't another vicious COVID outbreak. It's about a lockdown. They don't want to see a lockdown. I think a vicious winter COVID outbreak is highly possible, likely. But a lockdown is no longer in the cards. When these travel stocks took off, that's what they were signaling. And it means you can afford to take more risk on. You can buy some of the more aggressive stocks that are now down. Even better than that, though, it was the transports. The show, even better than the transport show, the banks. Oh, that's where the excitement was today. When you see the banks move up, you know you're going to have a good session. It's the most important group because it tells you the economy's buzzing and the market can handle a rate hike. And that's crucial because the market's been in a funk ever since Fed Chief Jay Powell retired the term transitory when it came to inflation. The term transitory had become our lovey blanket. So once that blanket was pulled, it got ugly. Now, today, the banks shrugged it off, though. That's gigantic because the banks are basically the market's offensive line. You don't notice how important they are, but they allow you to spring a running back industrial or a fleet of foot-wide retail receiver. Okay, so in other words, this is a difficult analogy. I'm going to grab the ball. Okay, so there's an offensive line, and that is these stocks that I'm talking about, the banks and the transports, particularly the banks. They block for you so you can run downfield, okay? And the ones that want to run downfield are the industrials, and then you want to pass the ball to the retailers. So you have time in the pocket because of the offensive line. The offensive line, typically the banks. Amazingly, they can't be considered leaders, but the beaten-down Chinese stocks failed to keep falling, too. Again, sometimes it's about the absence of negatives. So now we'll review. Banks, good. Travel, good. China, not bad. Which brings me back to sentiment. I did some work with my friends at MarketEdge this weekend, trying to identify an action point where this market can bounce on a catalyst like the public's collective decision to continue traveling, as represented by the rally in the transports. MarketEdge puts out this S&P Oscillator, and it's a reading, comes out every night. I pay for it, which measures buying and selling pressure in the market. When the oscillator's at zero, we're at neutral. But as it moves toward the positive mid-single digits, be careful. That means there's too much bullishness, be ready for fall. Mirror image on the downside. As the oscillator gets lower, it means the selling's become too severe. And that's how you get that coiled spring I was talking about last week. Ever since the pandemic began, we've known one thing about sell-offs. When the oscillator that the S&P keeps track of, this MarketEdge, when it trades to -5, it's like a magic line in the sand. Things get a little dicier when the oscillator penetrated the 5 level last week, even breached 7, -7, that is. It looked like we might be on the verge of something big and bad. Maybe we get some horrible Omicron numbers over the weekend, but when nothing happened bad, we finally got the inevitable oversold bounce. How long can the strength last? Here's the bottom line. I don't see much on the calendar that could derail the bull until Friday, when we get the consumer price index number, which I expect to be red hot. But in this market, 4 days is a lifetime. And for traders, today was a bird in the hand. Maybe 2 in the bush comes next week.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.